This one feels very practical for valuation work. GST, construction works contracts, under construction sale, ITC, reverse charge. Everything is mixed together. I want the full picture, not just isolated definitions. So can we start from the basic framework?
Yes, very rightly. This chapter is about GST Act 2017 and its impact on construction and property transactions. For valuation, this is important because taxes influence project cost, cash flow, sale price, profitability, and even market perception. If you ignore GST, your valuation may look correct on paper, but wrong in actual business terms.
So first, what exactly falls under construction services and works contracts?
Good starting point. Under 7.2.1, construction services and works contracts cover the supply of services related to construction activity. A works contract means a contract for building, construction, fabrication, installation, repair, renovation, or modification of a movable property.
So it is not only new construction?
No, not at all. It includes many forms of service. This matters because the tax treatment depends on whether the transaction is treated as a service contract and what kind of property or project is involved. For a valuator, this affects project budgeting, cost estimation, and input-output analysis.
And what about the rates? I can see different percentages mentioned.
Yes, GST rates vary depending on the nature of the work. In the mind map, you have examples like 5% for affordable housing, 5% for some non-affordable categories, and 12% for commercial works, though exact rates can change based on government notifications and project conditions.
So a valuator cannot assume one flat rate for all projects?
Exactly. That is a common mistake. A professional valuator must check the applicable GST rate because it changes the effective project cost and affects whether the project remains financially viable.
Now, moving to under construction versus ready-to-move property, this is where buyers often get confused.
Very true. Under 7.2.2, the difference is very important. For an under construction property, GST is generally levied because the transaction is considered a supply of service. The buyer is not purchasing a completed immovable property, but participating in a construction-linked transaction.
So GST applies because the property is still being built?
Yes, the tax logic is tied to the service component. But for a ready-to-move property with completion certificate or occupation certificate, it is generally treated as a pure sale of a movable property, so it is exempt from GST.
So timing of possession and completion certificate changes tax liability?
Absolutely. This is critical in valuation and transaction analysis. Two similar plots can have very different tax outcomes depending on whether they are sold before or after completion certification. That affects buyer demand, developer pricing strategy, and overall market behavior.
So from a valuation angle, under construction properties have a tax burden, but ready-to-move properties do not.
Correct. And that burden may influence pricing, affordability, and investor preference. Sometimes the market discounts under construction assets because of GST and time risk.
Now, ITC, input tax credit. This sounds like a relief mechanism.
Yes, under 7.2.3, ITC is designed to avoid cascading of taxes. GST paid on inputs can be adjusted against GST collected on output.
Inputs meaning materials and services used in the project?
Exactly. Raw materials, services, machinery, subcontracted work, these may all be part of the tax chain. The idea is that tax should not be paid again and again at each stage without adjustment.
From a developer's point of view, why is ITC so important?
Because it directly affects the true cost of development. Developers generally prefer structures where ITC benefit can be claimed because that reduces net tax burden. But sometimes the pricing structure changes. A lower tax rate may be offered without ITC, or a different tax structure may apply with ITC.
So the developer has to choose between tax rate and credit benefit?
Yes, in many practical cases. The decision affects project economics. A valuator must understand this because the net project cost, expected margin, and sale pricing all depend on it.
And buyers ultimately feel this in the final price?
Exactly. Tax structure travels through the project and reaches the consumer. That is why GST is not just a legal topic, it is a valuation topic too.
Now, reverse charge mechanism, RCM, what is shifting here?
Under 7.4.4, the liability shifts to the recipient. Normally, the supplier collects and pays GST. Under RCM, the recipient pays the tax directly to the government.
So the buyer or recipient becomes the taxpayer?
Yes, for specific notified services or situations. The mind map mentions it applying to specific services, including cases involving unregistered suppliers and certain services like legal services. This mechanism is important because it changes the compliance responsibility.
How does that matter to real estate?
Very much. Construction projects often involve many vendors, consultants, subcontractors, and service providers. If any of these fall under RCM, the developer must be prepared for direct tax payment liability that affects working capital and cash flow.
So RCM is not just an accounting entry, it impacts project finance?
Absolutely. Cash flow timing matters. For valuation, cash flow timing affects project feasibility, working capital planning, and overall risk profile.
So if I connect all branches together, GST changes project cost, selling price, compliance structure, and investment returns.
Exactly. That is the correct understanding.
Then the bigger valuation lesson is that tax is not outside valuation, it is part of it.
Very well said. In real estate, valuation must consider construction tax treatment, sales stage and completion status, ITC availability, reverse charge liability, and the final impact on income and cost.
So this chapter really teaches that a project is not just land and building, it is also tax structure, compliance burden, and cash flow movement.
Correct. And that is why a good valuator must read the project like a financial and legal system together, not like a simple asset alone.